Hey everybody, Steve Olson with the Investors Corner podcast. Back to you again. I've been thinking about this for a while because I feel like some days I spend a tremendous amount of time looking through Proformas, talking to investors about Proformas on residential and commercial properties. And what happens as a result is I see competition. People, well, I'm looking at your deal. I'm also looking at that deal. It looks like it has a better return. And you know what? If it does, great. I think every investor should get the best return possible. But you got to make sure that you're looking at all of the facts. And especially in the Gulf markets of Texas and Florida, we're seeing this a lot where proformas can be wildly inaccurate when it comes to two key expenses that are largely out of your control, as property taxes and insurance. So how do you know when you're looking at a proforma if those figures are correct? A lot of investors will believe what you tell them if it supports the narrative that they want, that this is a good deal. But you have to detach emotionally and evaluate those property taxes and insurance, because they're, two of the most commonly understated and misrepresented line items in real estate underwriting. So let's talk about it today. Let's talk a little bit about how to verify property taxes, or at least get really close, because it can be tricky, especially on new construction or on properties that are going through a significant renovation, right? It's one of the easiest things to check, one of the most commonly understood. And the only source that really matters is the county assessor or the county treasurer, right? Now, we do use some other websites that pull from those. The one that I like is called smartasset.com, right, that you can use, but don't ever use one single variable to drill down on this. Every county publishes the assessed value and the tax rate and the actual tax bills. These are all public records. So remember, a county assessor says, here's what the property is worth. By the way, not always equal to market value. Some markets, yes, some markets, no. So you have to drill down on that. Okay, and then from there, it's the mill rate, the levy rate that you have to calculate. But the wild card is, well, what are they ultimately going to assess these things at, right? The biggest mistake we see, a lot of investors and even sponsors, they look at the current tax bill and they assume that that's what the taxes will be going forward, right? When it's new construction, that's often wrong. Why? Because the current owner might be receiving a homestead or an owner-occupied tax rate. Homestead exemptions, those are designed for primary residences and not for investment properties. If, for example, we do a lot of work in Indiana, this happens in Texas too, where if somebody was living in a home, they get a much lower rate. But as soon as the county figures out that a non-owner occupant or an investor owns that property, those taxes are going to go up significantly. So once a property is sold to an investor, that exemption is removed and the assessed value may reset. Tax value increases. You underwrite that using the homesteaded tax, your numbers are going to be way, way too low, and you would have never done that deal in the first place. So you'll see a proforma that says something like property taxes are at $2,800 per unit per year. But when you dig deeper, that number is based on a long-term owner living in the property with a homestead exemption in place. As an investor, you won't get that rate. That difference alone can wipe out a big chunk of the cash flow. So here's what you should do instead. When you're verifying taxes, ask these three questions. Number one, is the current tax bill based on homestead or owner-occupied status? We need to know the answer to that. Number two, what's the non-homestead or commercial tax rate in the county? That's number two. Number three, will the property be reassessed on sale at or near the purchase price? So if the proforma doesn't clearly reflect post-sale non-homesteaded taxes, it's not a conservative underwrite and you're going to get killed. So here's another red flag, which is flat tax growth assumptions. If taxes are modeled growing at 1 or 2% a year in a market where property values are rising quickly, that's usually unrealistic. So at peak, we intentionally underwrite taxes as the exemption is gone and values rise because that's the reality for investors. And even we can get that wrong sometimes. Typically our proformas assume that expenses, including property tax, are increasing at 3% a year. That's what we underwrite. And, over the last few years, some markets have seen crazy, crazy increases in insurance and taxes. And, we've all had to deal with that. So that's certainly something that can happen. So when you're You can't have your cake and eat it too. Investors love it when they own a deal in a market that's increasing. They go, oh, my property is worth so much more. Well, your taxes are going to go up too. So you got to keep an eye on that, especially in Texas, right? I tell investors that in the state of Texas, property taxes are a blood sport, right? That is how they get so much of their revenue. They're looking to increase those as much as they can, as often as they can. And if you're the investor that's just kind of sitting by passively, they're going to get you. They're going to increase those taxes. And so you have to watch that assessment every year. And if it starts to get a little out of control, you can appeal those taxes. And sometimes it's a pretty simple process. Other times it's pretty complicated. But we continue to use Texas as an example here. There are law firms that specialize in this. And, I've got one for the properties I own in Texas, and we appeal every year. And, sometimes we get them to back off a little. Sometimes we don't. But the point is I'm keeping them in check. In fact, last year, I really hated the assessed value that they came up with for a fourplex that I own in Houston. And it was so off that I took them to arbitration. And I had my attorney do it, and we actually won and got the taxes to come back a lot. So cool thing is many of those firms are affordable. They charge you on results, not a flat fee where you're just going to pay and maybe get results. You're only paying if you do get results. And we can certainly make some recommendations for you Texan investors if you need some help there on some firms that have that kind of service. So here's the other one. This got out of control over the last few years too. How do we verify insurance? I got some insurance bills on some Texas properties that I own that are just downright prohibitive, and I'm looking for new options. And granted, that's because of things that were out of my control when the property was underwritten. But oftentimes, a Proforma might give a number that is too optimistic. It's trickier, and it's where we can see people get a little creative to a fault. So here's the reality. Insurance costs are based on replacement cost, construction type, roof age, loss history, local risk factors, not purchase price. So when you see insurance modeled as a tiny percentage of purchase price, you should have some questions about that, right? The best way to verify insurance is simple. Ask for an actual insurance quote, not a rule of thumb estimate. Not, what's the seller paying? An actual quote based on current replacement costs. It's smart to put that into your due diligence clause so you can handle that before you're required to close. So in a lot of these markets, like I told you, insurance premiums have jumped dramatically in just the last few years. Using old insurance numbers is not conservative underwriting. And you can play with deductibles and other things to try to get that down, and it's kind of your own risk tolerance. But make sure that your insurance line item includes the property insurance, liability coverage, loss of rents. If it's not clearly spelled out, the number's probably understated. I also see this a lot too when we do townhomes, for example, in Nashville, Tennessee, or we do our duplex and fourplex townhouse style properties in Indiana and Texas. Sometimes how these things interplay is there's the Master Homeowners Association, and they have a bulk insurance policy or a master policy across the development. And you might be getting what's called an HO6 policy that insures from the walls in. Having a good agent that understands how to get you the best HO6 policy that is complementary to the HOA's master policy is key. Oftentimes the deductible over here won't match the deductible over there, and you have to be aware of that so you don't get caught with a giant check that you have to write if something happens. So compare those assumptions, not just returns. It's one of the most important takeaways. Instead of asking which deal has the highest projected return, ask which deal is using the most realistic assumptions. If you underwrite it that way from the beginning, the deal is much more likely to go smooth for you. But if you're kind of pushing, if you're not checking these things on taxes and insurance, you will probably get a nasty surprise that will make you second guess ever having invested in that property in the first place. So 2 Proformas, they can look completely different, even for the same property, depending on how taxes and insurance are handled. I recently saw some Proformas in Texas, and I knew for a fact that those property taxes were understated by at least 50%. And sure enough, we've been hearing a lot about that from investors who invested in those. So you got to watch that stuff. So that's why we underwrite the way we do. We want to take that conservative approach to taxes and insurance, not because it makes deals look better. In fact, it usually doesn't. Sometimes they don't quite pop off the page like we would hope or like you would hope. But we believe that investors deserve realistic numbers. Surprises should be positive, not negative. Can't always control that, but we try as much as we can. And trust matters more than flashy projections. I saw at a trade show a couple of months ago, a general partner doing a syndication for real estate was offering on their signage a 23.67 internal rate of return. Get out of here with that. 23.67, right? I mean, investors want to know that they're being communicated with, their capital is being treated well. And usually when we're getting in multiple decimal points on those return projections, it just smells like a rat. So I'd rather lose a deal on comparison on paper than win one based on assumptions that we don't believe in, that we have to explain to you at a later date when you're angry and confused. So, final takeaway, if you're evaluating real estate investments, don't just look at the bottom line. Take a few extra minutes. You want to verify those taxes at the county level, confirm you're not using a homesteaded rate, ask for real insurance quotes, and understand how those numbers change after the sale. Those two line items alone can make or break a deal. Thanks for listening. We'll catch you on the next episode.